Global equities extend gains on Fed optimism. The Reserve Bank of Australia keeps its policy rate unchanged, pointing at persistent inflation risks, while US crude fluctuates near the 100-day moving average on geopolitical uncertainties as Israel refuses a deal with Hamas. So welcome. This is Swissquote's Daily Market Talk. So the week started on a positive note for the global equities, which continue to surf on that optimism that the Federal Reserve's next move won't be a rate hike, which I think is a bit overdone, by the way, and that next week's inflation data from the US could be a rude awakening. But this week, well, we have a few Federal Reserve speakers and US Treasury auctions that include 10 and 30-year US Treasury auctions to give us a better understanding or an idea of where bond traders stand before next week's fresh inflation update from the US. Now, from the Fed, well, Thomas Barkin said yesterday that the high interest rates should eventually cool down inflation in the US, but that the slowing deflation in goods prices could prevent the overall inflation from falling further if shelter and services inflation continue to rise, which is the case. So voila, we can't say more for now. We just have to wait for next week's inflation data to see where inflation is headed in the US. But the last 3 months haven't been brilliant. But one thing is sure, well, it is that the earnings season is going quite well in the US, and that analysts project that earnings for the S&P 500 will grow 17% this year, which obviously keeps sentiment in the S&P 500 supported near record high levels, although the 17% earnings growth could be hard to beat. But anyway, the S&P 500 jumped 1% yesterday above its 50-day moving average. The same is true with the Nasdaq 100. The Nasdaq 100 index also jumped more than 1% yesterday above its own 50-day moving average. Now, while the so-called reflation trade that's supposed to favor value stocks over growth peers continue to give support to the European Stoxx 600 index, well, it is also worth noting that a breakdown in EPS growth by investment style also shows that earnings growth is still much higher for growth stocks led by mostly AI-related big technology names than for value stocks, and this gap is huge, mind you. Because in numbers, value stocks print a negative earnings growth of around 4.5% in the first quarter, while growth stocks strike a 42% growth. The expectation for the next quarter is that while growth stocks will print an earnings growth of just around 24%, which is still huge in the second quarter, versus a 1% contraction for growth stocks. And the value stocks are expected to eke out a meager 0.6% earnings growth in the third quarter of this year, while earnings growth for growth stocks is then expected to ease to 18%, which is still big, and we won't see that gap close before the fourth quarter of this year, according to expectations, where value stocks are expected to print a 10% earnings growth versus only 16% growth for the growth stocks. So one thing that could narrow the gap faster than expected is an extended period of high interest rates in the US and elsewhere, but even then, we saw that AI actually helped the big technology companies look above the Fed's or others' rate policies, and BlackRock remains overweight in US equities that are overweight in technology stocks on solid corporate earnings, they say. So voila. Meanwhile, well, stocks in Japan remain quite well supported by the loose Bank of Japan monetary policy and a soft Japanese yen. Chinese equities continue to recover, and the CSI 300 index is back above its 200-day moving average since last week. Note that the index is up by nearly 20% since its February dip on Chinese efforts to boost its economy. And while investors are also looking to diversify their portfolios following record high levels in Western peers, but I think that it's just too early to say that the China trade is back on, given the ongoing property crisis in China, the tense geopolitical landscape, and also this ongoing trade and technology war with the Western peers. Now, this week, Xi Jinping is visiting Europe. And we have all these pictures and videos all over the place of Xi Jinping and his wife, who is super well dressed in this beautiful white dress, next to Emmanuel Macron's wife, who is dressed in this flashy red dress as a subtle homage to China, who loves red. And well, they all make these beautiful smiles to each other, they shake hands and so on. But obviously there's a mountain behind these forced smiles, because Xi Jinping asked Macron to avoid a new Cold War, while the EU just doesn't respond to that and just say they don't want China to dump prices of solar panels and electric cars, for example. And obviously Ukraine is a major headache. So we all know at this point we are not going back to the good old days of happy globalization anytime soon. And I really believe that the letter will continue to weigh on China appetite as well, without the help of the rest of the world, without the rest of the world buying the cheap Chinese stuff, while China could find it hard to go back to the glorious days. Elsewhere, on the geopolitical front, well, things move as well, though they are not necessarily moving toward the right direction, unfortunately. U.S. crude remained sold yesterday on news that Hamas said okay to the ceasefire proposal, but crude oil remains bid this morning near the 100-day moving average and near the oversold market conditions, as Israel refused the ceasefire deal and is on top of it preparing for a big offensive in Rafah. The $80 to $80.5 per barrel range is the key technical area to watch. That's where the 200-day moving average makes the major 38.2% Fibonacci retracement on year-to-date rise. Right now, oil is trading in the bearish consolidation zone, but the reflation trade, the geopolitical setup, and OPEC risks point that we could actually see a dip near the $77 to $78 per barrel zone and a recovery, because OPEC and its allies will likely extend supply cuts into the second half of this year to prevent from a global surplus to just come and press these prices lower. Iraq and Kazakhstan are working on curbing their production reportedly to get back into their quotas, but the US on the other hand has got our back covered. The daily production there has almost reached 13 million barrels per day, guys. 13 million barrels per day. That's more than Saudi Arabia, which pumps around 9 million barrels per day at the moment. So what I'm trying to say is, beyond the possibility of a short-term spike in oil prices, we will unlikely see the barrel of crude go too high or too fast. And well, that's obviously good news for your global inflation battle, because that's also going to prevent the global inflation from spiking too fast and prevent the central banks from hiking the interest rates in a surprise move. And well, speaking of that global inflation battle, the Reserve Bank of Australia left its policy rate unchanged at today's monetary policy meeting and, well, warned that inflation is declining, but it is declining more slowly than expected. That persistence of services inflation is a key uncertainty, that it will be some time yet before inflation in Australia is sustainably back to the target range, and that they will remain vigilant to the upside risk in inflation. Now, surprisingly, the knee-jerk reaction to the RBA decision has been a decline in the Aussie dollar to the 66 cents level, but we haven't heard the press conference just yet, and things could change rapidly. Elsewhere, well, we see that the dollar yen recovers timidly, but it recovers still after last week's most likely and presumed intervention from the Bank of Japan. The euro dollar tests the 200-day moving average resistance to the upside, while cable trades timidly above its own 200-day moving average, but with the risk of seeing these recent gains melt rapidly if the Bank of England gives a clearer sign of an approaching interest rate cut this summer in the UK at this week's monetary policy meeting. So all in all, things will be moving faster in the FX markets as major central banks near concrete action, and that will give FX traders a lot of fuel to have fun in the coming weeks and in the coming months. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.